There's a guy who worked at Microsoft from 2003 to 2018, saved aggressively, maxed his 401k, built up $750,000 by age 42. Then he quit to become a yoga instructor, making $38,000 a year. His friends thought he lost his mind. His parents stopped calling, but here's what nobody understood. He'd already won. Even if he never invested another dollar, that $750,000 would compound into $2.4 million by age 65 at 7%. His retirement was on autopilot. He just didn't need the stress anymore. Then there's the opposite story. A lawyer I know, 51 years old, makes $320,000 a year, has $1.2 million saved, still works 70-hour weeks because he's convinced he needs to hit $2 million before he can breathe. Except the math says if he stopped contributing today, that $1.2 million becomes $2.3 million in 12 years without him lifting a finger. He's grinding for a number he's already mathematically guaranteed to exceed. Both of these people crossed an invisible line. A line most investors never even know exists. The moment where your contributions stop being the main character in your wealth story, where compounding takes over so completely that whether you add another dollar or not becomes almost irrelevant to the final outcome. And here's the kicker. Most people are closer to that line than they think. They just don't know how to calculate it. So today, I'm going to show you the exact mathematical moment when your retirement becomes inevitable, when time and compound growth do more work than you ever could by saving. I'm going to give you the formula to calculate your personal crossover point and your coast number. And I'm going to explain why understanding this shifts your entire relationship with work, risk, and money. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan. And I only ask for your email to send the report, so I don't store any of your financial data. Link in the description. Here's the thing. Your wealth building journey has two engines. Think of them like two horses pulling a carriage up a mountain. Engine 1 is your contributions. This is the money you manually shovel into your 401k or IRA or brokerage account every month. Early on, this horse is doing all the work. You are the wealth. Without your paycheck, without your discipline, the carriage doesn't move. Engine 2 is compounding. In the beginning, this horse is weak, practically a pony. You've got $10,000 invested. It grows 7%. That's $700. Cute. Meaningless compared to the $20,000 you're contributing that year. But these two horses don't stay equal. One gets tired, the other gets stronger. And at some very specific point on the mountain, the compounding horse becomes so powerful that even if the contribution horse completely stopped pulling, you'd still reach the top. That point has a name. It's called the crossover point. The crossover point is dead simple. It's the moment your portfolio's annual growth exceeds your annual contributions. That's it. The moment the compounding engine generates more dollars in a year than you can realistically save and invest. Let me show you what this looks like with real numbers. Say you're investing $20,000 a year. Solid. Above the median for American households. And let's assume a long-run average return of 7% after inflation. Conservative, based on decades of S&P 500 data. When you have $100,000 invested, 7% growth gives you $7,000. Your $20,000 contribution is still doing 74% of the work. You're still the engine. At $300,000 invested, 7% is $21,000. Now you're roughly even. You and compounding are sharing the load 50-50. At $500,000, 7% is $35,000. Your $20,000 contribution now represents just 36% of your total annual portfolio increase. Compounding is the main character. You're the supporting actor. At $1 million, 7% is $70,000. At this point, your contribution isn't useless, but it's psychologically a rounding error. The portfolio is doing 3.5 times more work than you are. This is why people say it gets easier after the first few $100,000. It's not motivational talk, it's math. In the early years, you're Sisyphus pushing the boulder uphill. Around 300,000 to 500,000, depending on how much you save, the boulder starts rolling on its own. You're just keeping pace. Now here's where it gets really interesting. Once you understand the crossover point, you can run a thought experiment that answers the question people are terrified to ask out loud. What happens if I stop contributing at different checkpoints? Same assumptions. 20,000 a year, 7% growth, aiming for $1 million. If you contribute all the way through, you hit 1 million in about 23 years. That's the baseline, the standard path. But watch what happens if you stop at different milestones. Stop at 100,000. Takes you roughly 5 years to get there. From that point, compounding alone would take about 33 more years to reach 1 million. Total time? 38 years. You added 15 years to your timeline by stopping too early. The compounding horse wasn't strong enough yet. Stop at 300,000 instead. That takes about 11 years of contributing. From there, compounding carries you the rest of the way in approximately 18 more years. Total time? 29 years. You only added 6 years compared to the baseline. Why? Because you hit critical mass. The compounding engine had enough fuel to do heavy lifting. Now the wild one. Stop at 500,000. Takes about 15 years of contributions to get there. From that point, compounding doubles it to 1 million in roughly 10 more years. Total time? 25 years. Stopping at 500,000 only delays your $1 million milestone by 2 years compared to contributing the whole way. Let that sink in. Halfway to your goal in dollars is not halfway in time. Once you reach critical mass, once that second horse gets strong enough, your ongoing contributions matter less and less in relative terms. But now you might be thinking, okay, contributions don't matter as much after critical mass. But does that mean I don't need to invest anymore? No. That's where people confuse two separate concepts: the crossover point and what's called coast-fi. Let me explain the difference, because this is where the psychology gets weird. The crossover point is a psychological shift. It's the moment you realize compounding is doing more work than your paycheck. It feels good. It's validating. But it doesn't mean you're done. Coast-fi is different. Coast-fi is the true you no longer need to invest for retirement moment. It's the amount you need invested today so that even if you never add another dollar, compounding will grow it into your retirement goal by your target age. Coast-fi doesn't mean early retirement. It means freedom from pressure. You can downshift, take a lower paying job you actually enjoy, start a business, work part-time. Stop feeling like one bad year financially ruins your entire future. Here's how you calculate it. And I'm going to walk through this slowly because most online calculators get this wrong. First, decide how much you want to spend per year in retirement. Let's say $70,000. Next, subtract income you expect that doesn't come from selling your investments. Social Security, a pension if you're lucky, rental income. Let's estimate $25,000 from Social Security. That means your portfolio needs to generate $45,000 per year. Now, using the 4% rule, a guideline based on historical withdrawal rate studies, you divide that $45,000 by 0.04. That gives you $1.125 million. That's your target portfolio, your finish line. Now, here's the part that nobody explains clearly. To find your coast number, you take that target and you reverse engineer it using compound growth over time. The formula is this: target portfolio divided by 1 plus your expected real return raised to the power of years until retirement. Real return means after inflation. So if you expect 8% nominal returns and 3% inflation, your real return is 5%. Let's say you're 35 years old and you want to retire at 65. That's 30 years, 1.125 million divided by 1.05 to the 30th power. That comes out to roughly $260,000. Meaning if you're 35 years old and you have $260,000 invested right now, you don't need to contribute another dollar for retirement to work on schedule. Not because markets are guaranteed, Not because nothing can go wrong, but because time and compounding are now doing the heavy lifting. That's Coast FI. That's the moment the carriage reaches a flat enough part of the mountain that even if the contribution horse stops pulling, momentum and the compounding horse will carry you to the top. Let me give you a concrete case study because this needs to feel real. Meet Sarah, 38 years old, software engineer, makes $130,000 a year. She's been investing 15% of her gross income since she was 25. That's about $19,500 a year. 13 years of contributions. Her portfolio is now sitting at $420,000. She wants to retire at 60. That's 22 years from now. She wants to spend $60,000 a year in retirement. Let's assume $22,000 from Social Security. So her portfolio needs to generate $38,000 annually. Using 4%, that's $950,000 target. Now, her Coast number. 950,000 divided by 1.05 to the 22nd power. That's roughly $325,000. Sarah has 420,000. Her Coast number is 325,000. She's already passed it by a lot. What does this mean? It means if Sarah got laid off tomorrow and took a job as a park ranger making $45,000 a year just for health insurance and sanity, her retirement is still on track. She doesn't need to invest another dime. The 420,000 will compound into 1.2 million by 60, even if she never touches it again. That's not theory. That's math. But here's the danger nobody talks about. Reaching your Coast number creates a psychological trap. I call it the just one more year syndrome. You hit Coast. You realize you don't need to grind anymore. But you're so conditioned to optimize, to maximize, to push, that you keep going anyway. You think, well, if I work 5 more years at this salary, I'll have way more than I need, I'll have a buffer, I'll have options, and that's true. But here's what happens. Those 5 years turn into 10. You get used to the income, you upgrade your lifestyle, you buy the bigger house, you finance the luxury car, and suddenly your Coast number moves. You're back on the treadmill because your spending expectations inflated to match your income. I've seen this happen to people with $2 million saved. They're technically financially independent. They could retire today, but they've architected a life that costs $12,000 a month. So they feel broke. They're trapped by their own success. To be fair, there's a counter argument. Some people genuinely love their work. Some people want to leave a legacy. Some people are building something bigger than just their own retirement. And if that's you, great. Keep going, but make sure you're grinding because you want to, not because you think you have to. Now, you're probably asking yourself, okay, so what do I actually do with this information? Here's the move. Calculate your Coast number today, right now. Use the formula I just gave you. Target portfolio divided by 1 plus real return to the power of years to retirement. If you're below your Coast number, your job is simple. Keep contributing. You're still in the phase where your paycheck is the engine. Grind smart. Automate your investments. Don't try to time the market. Just feed the machine. If you're at or above your Coast number, congratulations. You just unlocked a cheat code most people never find. You have options now. You can keep contributing to build a bigger buffer. You can downshift and reclaim your time. You can take more career risk because your baseline is secure. But here's the most important part. Don't let your lifestyle inflate to consume the freedom you just created. This is the mistake I see constantly. People hit financial milestones and immediately raise their standard of living to match. They turn freedom into a new prison. Look, I've been running my own business for over a decade. I've been surrounded by accountants and fiscal lawyers who taught me how money actually moves. And I've got multiple hundreds of thousands of dollars invested. Skin in the game, not theory. And here's what I've learned. Most financial mistakes aren't math problems. They're brain problems. People don't understand how their own decision-making works. They don't understand loss aversion. They don't understand hedonic adaptation. They don't understand the difference between wanting more and needing more. The crossover point and Coast Fi aren't just financial milestones, they're psychological tests. They reveal whether you're investing to build freedom or to feed an ego, whether you're optimizing for time or for status, whether you understand the difference between enough and everything. Here's a quick story. There's a parable about a fisherman in Mexico. An American investment banker is on vacation. He sees a local fisherman dock his boat with a beautiful catch. The banker asks, "Why don't you stay out longer and catch more fish?" The fisherman says, "This is enough for my family and a little extra to sell." The banker, excited, launches into a whole plan. Catch more fish, buy a bigger boat, scale up, maybe franchise, eventually take the company public. "And then what?" the fisherman asks. "Then you can retire and spend your days fishing," the banker says. The fisherman looks at him. "I already do that." Now, I'm not saying don't build wealth. I'm not romanticizing poverty. The fisherman's life works because he lives in a low-cost economy and has simple needs. That doesn't scale for most of us. But the principle is real. At some point, more money doesn't buy more freedom. It just buys more complexity. Your Coast number is the mathematical proof of enough. It's the point where the machine you built is strong enough to carry you, even if you stop feeding it. So here's my 3-part framework for using this knowledge. 1. Calculate your Coast number annually. Not obsessively, not weekly, but once a year, check the math. See where you stand. If you're below it, you know your mission. If you've crossed it, you have new decisions to make. 2. Separate your identity from your income. This is the hardest one. We're conditioned to tie our self-worth to our earning power. Hitting Coast means your financial outcome is secure, but it doesn't change who you are. Don't let the freedom make you lazy. Don't let the security make you reckless. Use it to take smart risks, not stupid ones. 3. Design your life in chapters, not decades. Pre-Coast, your job is to build the machine. Post-Coast, your job is to decide what the machine is for. More wealth, more time, more impact? There's no right answer. But if you don't choose deliberately, inertia will choose for you. And inertia always chooses more of the same. I'll leave you with this. I've reviewed thousands of SEC filings, earnings reports, tax structures. I've seen how the ultra-wealthy actually build and protect money. And the dirty secret is this. Most of them hit their Coast number decades before they stopped working. They kept going not because they needed more money, but because they didn't know what else to do. Don't be that person. Understand the math. Know your crossover point. Know your Coast number. And when you hit it, make a conscious choice about what comes next. Because lazy investing built more fortune than crypto memes. And knowing when you've already won is the ultimate edge. If this clarity hit different, like and subscribe. Drop a comment with your current milestone. 10,000, 100,000, crossover, Coast. Let me know where you're at. And if you want that free calculator that actually gets the math right, links in the description. Now get back to building your machine.